Hello and welcome to Smaulgld. In case you missed it, top gold and silver stories for the week ended August 20th, 2016. The cartel, central banks, the powers that be are losing control. And we'll see how they're not. Central banks continue to dominate the market this week. Another Fed interest rate yak attack is in full effect. We'll talk about that. And let's get to the stories of the week. Gold and silver. Gold closed last week at 1341, down from the week, up slightly from the week before at 1335 an ounce. Silver got hit a little harder, didn't rise, it went down to 19 and a quarter, down 2% from 1964 the week before. As a result of the decline in the silver price and the small increase in the gold price, the gold silver ratio has crept back up towards 70 to 1. You can see all the historic gold silver ratios on a daily basis, monthly basis, 1, 5, 10-year basis by clicking on this link. Again, lots of information at the Smaulgld site that is not included in this podcast or in any of the YouTube videos. Plenty of charts, plenty of information, plenty of archives. You could check out Smaulgld. Also, subscribe to Smaulgld. You'll have the Smaulgld blog posts sent to you, the more important ones, not everyone that we publish on as soon as they come out. Now here's a chart of the week, why I say central banks are not losing control and why the powers that be are not losing control or the Fed is not losing control. Take a look at the Dow Jones again versus gold. Yes, gold has had a wonderful year, but the Dow Jones, since hitting its bottom, has kept pace with the price of gold. There's no reason for that other than the powers that be in the cartel and the central bank are priming the markets. Now, the central banks did lose control in 2008, no question about it. But since 2008, they have reclaimed their grip on the markets through QE, zero interest rate policy, negative interest rate policy, FDIC rules bailing out the too big to fail banks, bailouts in general, changing of accounting rules, allowing the too big to fail banks to hold assets that mark them to whatever they decide to mark them at. They've monetized debt. They've bought government securities, printed money and bought government securities. They have purchased government bonds. We now find out that Swiss National Bank is heavily invested in the U.S. equity market. The Bank of Japan owns stocks, is the top owner of about 20% of the Nikkei 225. So you see, the central banks learned their lesson. They lost control for sure in 2008, but they are not losing control now. They've actually firmed their grip, and they realize that the stock market is a very important stool to their whole game. And they are willing to prop it up, not just indirectly through low interest rates, negative interest rates, which make stocks more attractive to private investors. They'll buy the stocks themselves if they have to prop up the market. Fed does the same thing. In order to prop up the dollar, they talk about rate hikes. They don't come, but they talk about them, and people still listen to them. Let's take a look at some of the stories that we've covered. Okay, so here's an example. Deutsche Bank. Now, this isn't the Bank of Deutsche, so it's not like Deutsche Bank is accumulating gold and silver mining shares, but it highlights that the investment managers are moving into gold, yes, but they're not moving into physical gold. They're buying these gold and silver mining shares along with, and here's a chart that shows what the Swiss National Bank owns. Now that is what the Swiss National Bank owns on the left. They actually own that. That's not on behalf of clients. That is the Swiss National Bank's proprietary portfolio. They own about $63 billion worth of U.S. stocks, of which about 1 billion or 1.5% of the portfolio is in mining shares. So Deutsche Bank, Swiss National Bank, just two examples of when money moves into gold and silver, it moves into paper gold, Barrick's gold and silver mining shares. Let's see some of the other stories during the week. There's an interesting story. I won't cover it. Nazi gold train. Is it real? There's some more research into that. Rothschild buys gold. It was an interesting story about Rothschilds. Joe, now here's one, and kind of a blast from the past. The media, Bloomberg's, AP, Reuters, I view them all as one of the same. They've always been against gold. They've always trash the gold. And one of the things they used to always say was gold doesn't pay interest, gold doesn't pay interest. It'd be in every article, no matter what the article was about. They would try to let you know that gold doesn't pay interest. They've since stopped, and I've been pointing out for 2 or 3 years that's kind of irrelevant that gold doesn't pay interest. It's not supposed to pay interest, but more importantly, a lot of bonds don't pay interest. In fact, they charge you to hold your money. In any event, we still see this type of article from time to time, and basically Joe Doe from Bloomberg, gold is losing its appeal for investors. People don't believe in the gold rally. That's the headline, and that's people. They always mean people in general. Economists say, they mean all economists. And of course, the propaganda is the U.S. jobless claims have been holding steady at a 4-decade low, highlighting strength in the job market that signals the economy would probably be resilient in the face of an interest rate hike by the Federal Reserve. Higher rates cut the appeal of gold, which doesn't pay interest or offer dividends like assets such as bonds or equities. So just a reprise of what we've heard in the past, but they, again, gold goes up a bit too much, you start to see these types of articles that the gold rally is over. Silver rally, don't even talk about, because if there's any attention on silver, there's a problem, because if people rushed into silver, the market is so small, it would kind of go ballistic. More stories here. Soros slashes gold holdings in second quarter. They're making a big deal out of that. The Soros management company did have gold according to its SEC filings and did have Barrick stock. That was it. And the gold that they had was GLD. And they sold down some of their GLD and they sold off their Barrick stock. It's not like Soros poured heavily into gold, meaning he did like the Swiss National Bank or the Deutsche Bank fund managers buying 25, 30, 40, 50 different mining shares and all of a sudden dumped them. No, he made a quick profit on Barracks and he got rid of it. But of course, they're making a big deal out of the fact that Soros held gold probably for 6 weeks and then got rid of it. Here's something on the Swiss National Bank. We've seen that before. Central bank intervention. This is the important point. Zero Hedge had a quote. It's clear that central banks are dominating markets. Sound familiar? That's what I've been saying. Central banks are the main drivers of this. It's not fundamental. No kidding. It is not fundamentals that are driving the Dow, the S&P, the NASDAQ to all-time highs. But it is a signal, a clear signal, that central banks are not losing control. They are gaining control, as sad as that might be. Economic data, Empire Fed down. So you got all this bad economic data, or at best tepid economic data, and the stock markets are rising to all-time highs. Why? Because the central banks, the cartel, the powers that be have control, and they're gaining more control. Eventually, yes, it's not sustainable. I get all that. But who knows how long, when they're in charge, if they can print money and buy shares and they can lower interest rates and they can dominate the media and they can dominate the politics, they are in control. So it's kind of foolish to think that they're not in control, that somehow if you go out and you buy 6 or 7 maples or silver eagles, that you're somehow battling the cartel. Anyway, I digress. War on cash, interesting story here, of course, from CBS News on why cash is not allowed. They kind of tout it as a wonderful thing. You go into the store, you don't have to make change, you don't have to carry cash. You all know what I think about that. But if you don't know what I think about that, you can go to the Smaulgld Dark Side series and read the dark side of a cashless society. I lay out all the negatives of a cashless society. There's really nothing positive other than if you like not to use cash, it's fine. As long as it's your choice to use your credit card or some other non-cash item or barter, that's even better. That's fine. I don't care what people want to use. What I'm concerned about is when they force you to use it and basically they know exactly what you're doing and it's a freedom issue. U.S. Mint sales update. And we covered earlier in the week that the U.S. Mint sales are very low, and in fact, they came out and they said, well, they didn't come out. Well, let's get this clear here. The silver doctors reported that an authorized purchase of the Mint told them that they were going to stop making American Silver Eagles this year because there's basically no demand. And whether that's true or not, I tend to believe that it is. The numbers bear it out. It looks like there were a lot of sales into the authorized purchasers earlier in the year, 4 million a month, and then it fell off the table. The sales are down to just 1.3 million last month. They're only at about 580,000 this month. Whether they stop production or not really doesn't matter. The fact is the authorized purchasers have stopped buying, and those numbers are available. They have stopped buying the American Silver Eagles in large quantities, which would make sense then. Why would the U.S. Mint continue to make them in large quantities if the authorized purchasers have slowed down their purchases of American Silver Eagles? Another story of a British billionaire buying gold. Of course, it's probably GLD, not physical gold. This is the main story. Fed chatter. The dollar fell overnight earlier in the week. I think it was Monday night or Tuesday night. And the next morning, Dudley is out, the New York Fed president. It's possible we might raise rates next week. Atlanta Fed President Lockhart's out there. At least one Fed rate hike could be warranted this year, maybe two. And I tweeted this out. There's your crying wolf here. 2 rate hikes are conceivable, said Lockhart. Rate hike, rate hike, rate hike. My view on the Fed is when the dollar gets to a certain point, that's when the yak attack starts. They cannot have the dollar fall below a certain level. They eventually do want to do QE, but they have to have the dollar much higher. If people stop believing them, the rate hikes are off the table. The dollar craters. We saw that. I'll do a video on this tomorrow, kind of an update of the one that I had done. I think it was entitled "Will the Fed Sacrifice the Markets for the Dollar?" Which they won't, because the Fed is in charge of helping the Treasury maintain the dollar, and they do that by open mouth operations, yakking about rate hikes, and if they have to, if they've lost some credibility, they'll actually raise them a quarter point. They're never going to normalize rates, but they are going to raise them if they have to. If that dollar falls much lower, they will. But the yak attacks seem to work. The dollar went up a bit after they started this. One thing is true. Whether or not the Fed is losing control, they are losing credibility with this rate hike nonsense, because they said, June is on the table, June is on the table. Oops, Brexit. Well, they knew Brexit was a possibility. There's always an oops why they don't do it. But let's move on from our crying wolf and see what else we got. CPI was, if you believe these numbers, this is their numbers. They say there's no inflation. Okay, well, if there's no inflation, then the Fed hasn't met its target of 2%. Which means they can't raise interest rates. We know that those CPI numbers are skewed, and they use hedonics, and we know there's more inflation. If you look at the healthcare cost, the rent cost, education cost, if you call that going to college education, those types of things are all way up. But certain computer items are down, things they put in the basket. But in any event, these numbers don't support a rate hike, according to the Fed, because they're not near their 2% target. But of course, Reuters is saying the economy is gaining momentum. Here's that word solid again, but solid gains in industrial output, which was not true. It was just solid over the month prior. Year over year, it's down. And home building suggests a pickup in economic activity that could allow the Federal Reserve to raise interest rates this year. So you see the correspondence with the media with the Fed's pronouncements. Not that the Fed is going to raise rates, but the Fed says it's going to raise rates, and immediately Reuters, AP, and Bloomberg, they kind of make sure that in parallel, they're talking the same game. That, the economy is getting better, or will get better in the second half of the year, so this rate hike threat is real. They don't criticize the fact that the Fed is always talking rate hike and never doing it. No, what they say is, this data right here, this gives us credibility. This gives the Fed credibility to raise hikes next year because they're solid, they're robust, they're going to gain momentum next year, and the Fed's got to stay on top of this. And we see that constantly in all the stories. Industrial production, and we already covered that. War on cash. Here's another one. These come out all the time. The Economist. Why economists? At least they say some economists want to eliminate cash. You click on that, you can read all the nonsense, or I can refer you back to the Smaulgld article on the dark side of a cashless society. Read both of them, see what you think, put comments in the bottom, email me. I just am not in favor of a mandated cashless society at all. Here's just a point I tweeted out. Even if the Fed raises rates at each of the September, November, and December meetings, which no one thinks they will, they're not even saying they will. They're saying it's possible they might raise them twice this year. That would only be half of what they projected in 2014. So the Fed is very clever. They go out there, they overpromise and underdeliver. But in the short term, they make it sound like they're going to overdeliver. And again, I point back to in 2009 had the Fed said we're going to do 6-7 years of QE, we're going to blow $4.5 trillion, we're going to buy $2.5 trillion worth of U.S. Treasuries, we're going to buy $2 trillion of the mortgage-backed securities from the too big to fail banks. If they'd said that and announced that was what they were going to do in 2009, the dollar would have collapsed. But instead, what did they do? They started, they stopped, they said, we're going to do it, we're going to taper, and then when we taper, we're going to raise rates. So they constantly they kick the can down the road, and then when they realize that people are on to them, that they are just yakking, that then they have to say, well, they have to step up the yakking, say, no, but we're gonna do it twice this year. And that has some impact, but again, just like QE, it has a declining impact the more they do it. Philly Fed, Reuters initial claims are down, so it reinforces views of labor market strength. Yeah, okay. So the initial claims have been down. The labor force participation rate is down. The labor force participation rate since 2009, since the height of the Great Recession, for those in their prime working years, is lower now than it was then. The only group whose labor participation rate is increased, and I have a blog post on this, I put a link here, are those 55 and over, those 65 and older. And the reason they're back in the workforce, well, they have to be back. They can't retire on their negative interest rate or zero interest rate bank deposits, and they're not making any money. So they go into the workforce, and what does that do? Go to your big box stores. Go to the grocery stores. You see senior citizens working where 20, 30 years ago, you would see high school, no one in high school works anymore, and college age people working in those jobs. Not anymore. So the older people have to work, and I think the employers prefer the older workers. They're probably easier to manage. They're not interested in going out after work or getting off early and doing things. They're just looking to make ends meet. So they hire the older workers over the younger workers. It's a very bad situation that this negative interest rate, low interest rate policy has created. It has destroyed savings and has destroyed retirement and has destroyed the future of the younger people who should be getting this job training instead of a 65, 70-year-old person having to do the job, which basically is a low-skilled job. It's an honorable job, but still it's something that an entry-level person should be doing. And Fed chatter, it just continues. You know, Williams, he loves to yak rate hike. His latest, waiting too long to hike rates could be costly. You know, we have a strong labor market. We have full employment. Well, then raise rates instead of talking about it, but they never learn. Anyway, that's all for this week. Please sure to sign up for Smaulgld updates. Be sure to check out the website and also subscribe to the YouTube channel. Thank you very much.